The Silicon Valley market just sent its most contradictory signal all year. As we wrapped up October, the number of new listings actually declined by 10% from the month before, just as you would expect in the market preparing for the holidays. But at the same time, the number of sales, the number of homes that actually changed hands, went up by 6% compared to September. How is it possible? Well, this isn't just a statistical blip. This is the entire story of the market right now. It points to a powerful underlying force of pent-up demand finally meeting a very specific set of financial conditions, resulting in accelerated pace of sales. This is exactly what you must understand if you are thinking of buying or selling this fall holiday season. Many people will be confused relying on the national news, watching national trends, but real estate is local, sometimes local down to the side of the street. In this video, we're going to dive into the Bay Area data, explore the powerful why behind it, and give you a precise strategy for the Silicon Valley market. All right, let's get straight to the numbers for October 2025, looking at San Mateo and Santa Clara counties combined. The overall median sale price for all homes landed at $1,650,000. We can make two observations here. First, it's exactly the same as it was this time last year, showing annual stability. But second, it is an increase of 1.2% or of $20,000 from last month, which shows continued market upward pressure. What is fascinating, that if you look separately at single-family homes versus condos and townhomes, median home sale price for both went down. The median price for single-family homes ended at $1,925,000. That's a 1.3% decline from last year. The median sale price for condos and townhomes was $948,000, representing a 3.4% decrease year over year. What this means? Buyers are holding the line on price. The aggressive appreciation of the past is gone, replaced by a more stable, level-headed market. Both single-family homes and condos, which had been moving at a very different pace since the beginning of the year, seem to be getting back in sync, both showing slight year-over-year price moderation. In terms of inventory, the number of new listings that came on the market in October was 1,891. That's up 4% from the very slow October of last year, but it's a significant 10% decline from the previous month. This drop in new listings pulled down our total active inventory, which is down by 8% from last month. These are classic signals of the market heading into the holiday season. Fewer sellers are listing their homes, which should mean that the market is cooling off. But it's not. Despite the drop in the number of homes available for sale, the number of sold homes in October was 1,557. That's a 6% increase compared to September. This is the tension in the market, and the demand indicators back it up. The median time on the market is holding at just 13 days. That is incredibly fast. It's just 1 day slower than last year's 12-day frenzy. And to top it off, the average overbid percentage, what buyers are paying over the list price, actually grew from 2% to 3% month over month. It is not a massive jump, but it is a directional change. It tells us that competition for good homes is as strong as it's been all year. So we have this central puzzle: falling inventory, rising sales, and continuing strong demand. What is fueling this fire? It is not one single thing. It's a powerful combination of three factors. Factor number one: the life must go on pent-up demand. For the last 18 to 24 months, buyers have been on the sidelines, paralyzed by the interest rate shock and economic uncertainty. But life doesn't stop. People have new jobs, families grow, and the need to move eventually becomes a must. This is life cycle buying. The demand has been building in the background for years, and it's finally finding a crack of opportunity. These are serious, committed buyers who have adapted to the new normal. Factor number 2, the interest rate thaw. This is the other side of the pent-up demand coin, and it's all about the sellers. For the longest time, sellers have been locked in by their 2.5 or 3% mortgage rates. The idea of selling their home only to buy a new one at 7% rate was a non-starter. But two things have changed. First, interest rates, while still relatively high, have stabilized and pulled back from their absolute peak to the lowest level this year. This slight easing isn't just a financial change, it's a psychological one. It signals to the sellers that the worst of the volatility may be over. Second, just like buyers, sellers' lives must go on. That lock-in effect only lasts so long. They too need to move for new jobs, schools, or to be closer to the family. This psychological thaw, combined with the life's necessities, is giving them the confidence to finally make the jump. They're selling their homes, and they're also becoming buyers, contributing to that 6% increase in sales. Factor number 3 is record high stock market. This is the fuel. Here in Silicon Valley, our real estate market is uniquely and directly tied to equity compensation. A record high stock market isn't just good news on a financial report. It is liquid capital. It is the down payment. It is the cash to bridge the gap between an old mortgage and a new one. This wealth effect gives buyers both the confidence and the ability to compete. It's why we're seeing that overbid percentage tick back up to 3%. Buyers feel more secure in their finances, and they have the RSU or stock sale cash to prove it, allowing them to bid aggressively for the best available homes. So, what does this mean for you? First, the holiday window is wide open. My advice for sellers is clear. Do not mistake slowing down for slow. The data proves that serious buyers are out in force right now. With new listings down 10%, your competition from other sellers is lower. This is your window. Many sellers make the mistake of waiting for the spring market. I'm telling you, the fall into holiday market has a distinct advantage, less competition, and buyers who are driven by necessity. Second, price is your weapon, not your wish. Because overall prices are flat year over year, this is not the market to test a high price. Buyers are empowered by the stock market, but they are also disciplined and educated. A 1.3% drop in single-family home prices year over year tells us they will not chase an unrealistic number. The strategy is simple. Price your home right, and you will get 10, 15, 20 people through the door. This is how you create a competitive environment. You do not get overbids by starting 10% too high. You get it by starting at a compelling price that ignites a bidding war. Number 3, preparation is not negotiable. With only 13 days on the market, buyers have to make snap decisions. They will gravitate towards the home that is ready to move in. As is will not get you a premium price in this market. Fresh paint, modern staging, and the pristine inspection report are not optional. They are the cost of entry to getting multiple offers and a successful sale. Now for buyers. It may feel intimidating, but there is real opportunity here. First, become offer ready before getting in the car. Let's be clear. 13 days on the market is not a thinking period. It's a transaction period. You cannot find a home on Saturday and think about it until Wednesday. By then it may be gone. Offer ready means you have your financing fully underwritten, not just pre-qualified. It means your down payment cash is liquid and accessible. And it means you and your partner have already decided on your non-negotiable criteria. The time to analyze your finances and priorities is before you find the house, not after. Second, focus on the sync-up opportunity. Remember that data point? Single-family home prices are down by 1.3% year over year, and condos are down by 3.4%. This price stability is your friend. It means you aren't fighting the runaway appreciation we saw in 2021. You can negotiate. The best opportunities are not always the brand new listings that spark a 20 offer frenzy. Look for the homes that have been on the market 15 to 20 days. Often these are properties that were just slightly overpriced and the seller is now starting to get nervous. This is where you have leverage. While everyone else is fighting over the new shiny object, you can find incredible value. And number 3, look at total cost, not just price. With prices stable and rates having pulled back from their peak, your total cost of ownership is more predictable. Don't let stories of bidding wars scare you. It only applies to a fraction of the homes. Be methodical. Find a home you love, and let's run the numbers. Setting the right price may give you room in your budget to buy down your interest rate or make the upgrades you want. So, what's the one clear takeaway from this October report? The market is not slowing down in a meaningful way. It is consolidating. The inventory crunch is real, but the combined force of pent-up, life must go on demand, stabilizing rates, and the stock market wealth effect is keeping the engine running strong. Understanding these complex dynamics is the key to making a smart move, not just a fast one. If you're wondering how much this data applies to your specific home or your personal search, I'm here to help. Let's schedule a complimentary, no-pressure consultation to brainstorm your moving plans. My contact information is in the description below. Thank you for watching. Please share this video with anyone you know who is trying to make sense of this market. Till next time.